$750,000. Right now, before you've done a single thing different today, your portfolio gains or loses more in a single average trading session than most Americans put into retirement accounts in an entire calendar year. According to Fidelity, the median 401k balance at the end of 2025 was just $44,115. That's the median, meaning half the country has less than that saved for retirement. You have 17 times that number sitting in an account. And a routine 2% market swing just moved $15,000 before you finish your second cup of coffee. That is not the impressive part. The impressive part is what happens in the next 12 months, and whether you navigate it or let it quietly undo what took you decades to build. Here's what this video is actually about. At $750,000, most people make one of three silent mistakes. They don't register as mistakes in the moment. They feel like reasonable choices. They feel like rewards. That is precisely what makes them expensive. I'm going to break down all three, give you the exact math on each one, and walk you through what to actually do instead. Because I've spent over a decade running my own business, surrounded by accountants and fiscal lawyers who showed me how money actually moves at this level. I have skin in this game, multiple hundreds of thousands of dollars invested. And the pattern I keep seeing is always the same. The habits that built the number are the exact habits that start to quietly erode it. Here is the metaphor I want you to hold on to for this entire video, because it's going to come back as both an explanation and a punchline. Think about a speedboat versus a supertanker. When your net worth was at $50,000, you were in a speedboat. A decision goes sideways, you turn hard, you correct fast, you absorb the mistake in a year or two of saving. You can gun the engine, take risks, move quickly. That's how you built momentum in the first place. But at $750,000, you are no longer in a speedboat. You are at the helm of a supertanker. Supertankers do not turn on a dime. They take miles to slow down. A wave that capsizes a speedboat barely rocks a supertanker, but a mistake that splits a supertanker open cannot be corrected in the moment. The rules of navigation are completely different, and most people cross 750 still sailing like they're operating a speedboat. That is where the money goes. In a few minutes, I'm going to show you the single risk that most retirement calculators don't even attempt to model, a structural threat that can separate two people with identical portfolios by nearly $500,000 over 20 years through no fault of their own. But first, there's a problem hiding inside the quarterly statements you're probably not reading closely enough. Let's talk about fees. According to an ACE Private Risk Services report noted by Forbes, the average cost of a $1 million personal umbrella policy is $383 a year. I'll come back to that number in a few minutes because it matters more than you think. But first, advisory fees. On a $1 million portfolio growing at 7% annually over 30 years, a 1% annual fee could shrink your portfolio by about 25%, translating to nearly $1.9 million less. On $750,000, paying a 1.2% advisory fee means you're writing a check for $9,000 a year, every year, whether the market is up or down. Your advisor collects the same payment when the S&P drops 20% as when it runs 15%. That's not an incentive structure designed around your interests. That's a subscription to financial comfort that scales with your success. Here's where the supertanker math changes everything. At $10,000, 1% is $100 a year. Annoying, but inconsequential. At $750,000, it's $7,500 per year, every year, compounding against you. The cost of a 1% expense ratio versus 0.1% represents a 22.4% loss of ending wealth after 30 years. On $750,000 compounding at 7%, that isn't a rounding error. Over 25 years, a $500,000 portfolio could lose over $500,000 in potential growth due to fees alone. Scale it up proportionally to $750,000. And you are looking at the difference between a comfortable retirement and one that forces you back to work in your 70s. But the headline fee is only half the damage. The other half is what economists call the opportunity cost, the compounding that never happened on every dollar that left your account. The indirect cost is the growth those fee dollars would have generated if they had stayed invested. The $1,000 taken in year one would have compounded for 29 more years. At 7%, $1 becomes $7.61. Multiply that across thousands extracted annually, and you understand why John Bogle called compounding costs tyrannical. Now, you're probably thinking, but a good advisor provides real value. And you're right. Tax strategy, estate coordination, behavioral coaching during a market crash, withdrawal sequencing in retirement, those services have measurable financial value. The question isn't whether advice is worth money. The question is, do you know what you are paying in actual dollars per year? Not as a percentage, in dollars. Ask any financial professional one blunt question right now. What is my total all-in annual cost in dollars? If they cannot answer that in plain language within 60 seconds, that silence is your answer. A 1% AUM fee isn't outrageous, but it isn't just 1% either. On a $750,000 to $3 million portfolio over a 20 to 30 year retirement, the total cost difference between AUM and flat fee models ranges from $600,000 to over $5 million. That is real money that either stays compounding in your account or gets paid out in management fees for services you may or may not actually be receiving. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Most people at 750 have accounts scattered across 4 or 5 different institutions from different life chapters. An old 401k from a company they left years ago. A Roth they almost maxed out in 2021. A brokerage account opened during the COVID market run-up. A checking account carrying far too much cash. The fees are distributed, the expense ratios are buried in statements nobody reads, and nobody ever added them up because nobody needed to until now. At this level, one afternoon of reading your own account statements is worth more than most investment tips. Here's the thing about the fee problem. It's real. It costs most people at this level tens of thousands of dollars in eroded compounding over time. But it is not the biggest leak in the hull, not even close. The biggest leak has nothing to do with your advisor. It has everything to do with the sentence your own brain whispers to you the moment you see that number on the screen for the first time. You've arrived. That sentence is the most expensive lie in personal finance. And here is the data that makes it concrete. According to a 2024 survey by debt.org, 36% of Americans earning over $100,000 a year live paycheck to paycheck, a direct result of lifestyle inflation. 1 in 3 people with solid 6-figure incomes consuming every dollar they earn, not because they're irresponsible people, because income growth and wealth growth trigger spending growth automatically, and nobody warned them it would happen this way. This has a clinical name. Lifestyle creep is the pattern where discretionary spending increases proportionally with income, leaving the gap between earning and saving unchanged or narrowed over time. You think the problem is that people spend on the wrong things, but actually the problem is that the reference class shifts. When your net worth was $100,000, your social circle probably included people at similar wealth levels. Your spending norms matched the environment. At 750, you're starting to move in different rooms. The neighborhood you're looking at for the next house upgrade, the cars and the driveways at the school your kids attend, the restaurants where your professional network meets. What felt extravagant at $150,000 feels standard at $350,000, not because values changed, but because the baseline around you shifted. You didn't get a yacht, you got a slightly nicer apartment, a car that's more reliable, a gym membership that's actually good, 3 more streaming services, dinners out 3 times a week instead of 1. Each upgrade felt proportional. Each one felt earned. The mechanism is straightforward. You earn more, your standard of living adjusts upward to match, and wants gradually reclassify as needs. But here is the supertanker math. A $2,000 per month increase in your spending quietly redirects $24,000 a year away from wealth building. At 7% annual return, $24,000 invested every year for 10 years becomes roughly $330,000. The slightly nicer lifestyle didn't cost you $2,000 a month. It cost you $350,000 in foregone compounding. You simply cannot feel that transaction when it's happening. The supertanker is losing momentum, but you're not watching the engine gauges. There's research from behavioral economists documented across multiple independent studies that lottery winners and high-income earners who didn't adjust their lifestyle within the first 12 months of economists' significant wealth event tended to preserve it over the following decade at dramatically higher rates than those who upgraded immediately. The first 12 months appear to be the critical window. The brain still registers the new number as new. The resistance to upgrading is still high. Miss that window, and the new spending level hardens into baseline. And here's the brutal psychological truth. Baselines almost never move downward voluntarily. Anyone who has tried to move from a large house to a smaller one on purpose, not because of financial necessity, but by choice, knows this viscerally. The math is simple. The psychology makes it nearly impossible. The fix removes psychology from the decision entirely. When income increases, immediately raise your automatic savings transfer by at least 50% of the net increase before adjusting any spending income growth is split between wealth building and an intentional lifestyle upgrade. The key is automating the savings decision first, before discretionary spending expands to fill the new income. Freeze the lifestyle deliberately for 3 years, not permanently, 3 years. Let compounding, not your paycheck, carry you from $750 to $1 million. At a 7% annual return, $750,000 grows to roughly $1,050,000 in about 5 years, even if you add nothing. You can't outsave your way to $1 million from here. The compounding is already running faster than your contributions. Your job is to stop steering the supertanker into rocks. Knowing all of this and actually building a system around it are two very different things. Here's the honest part. I had access to the same data years ago. It didn't change anything for me until I built a structure around it, which is exactly why I created the Exit Code. It's a digital book built on 50 years of actual retirement data, not opinion or motivational framing. 8 chapters, no filler. The part most relevant to what we're discussing today is the chapter on what I call the dynamic withdrawal method, a framework that replaces the outdated 4% rule with something that holds up when you stress test it against real historical market sequences, including the ones where lifestyle creep has already happened and you're pulling money from the portfolio during the wrong years. There's also a chapter on the unretirement paradox, why 81% of early retirees in one specific documented community went back to work within 5 years of retiring, and it had nothing to do with running out of money. That's a predictable pattern the financial planning industry doesn't model, and it's worth understanding before you make irreversible decisions. The book also includes a mathematical framework that turns the vague, maybe someday I'll retire conversation into a specific calendar date with specific numbers attached to it. You can get it for less than what you'd spend on dinner out through the link in the description. Every year the math is ignored, it compounds against you, and that's not a sales line, it's arithmetic. Now back to the third mistake. Stay with me, because this next part changes the math in a way most financial channels don't discuss at all, and it's the one that blindsides people who did everything else right. You think the problem at 750 is picking wrong investments, but actually the problem is something almost completely outside your control. The year your life happens to change. There's a concept called sequence of returns risk, and the math behind it is quietly devastating. Here's the version you actually need to understand. Imagine 2 people, call them Marcus and David. Both retire in the same year. Both start with $750,000. Both average 7% annual returns over the next 20 years. The only difference is when the bad years hit, Marcus gets a 30% market crash in his first 2 years of retirement. He's pulling $50,000 a year from the portfolio to live on. He's selling shares at fire sale prices to cover expenses. Those shares are gone forever. They cannot participate in the recovery. David has better timing. He gets positive early returns, absorbs the same crash in later years, same average return, same withdrawal amount, same 20 years. Their ending balances. 2 retirees with identical portfolios and average returns can experience nearly a $500,000 difference in ending values based solely on when losses occur, not based on their investment selection, not based on their savings rate, based on the calendar. Research by retirement economist Wade Pfau estimates that approximately 77% of a portfolio's final retirement outcome can be explained by the returns of just the first 10 years. 77%. The decade you happen to hit. Not your stock picks, not your expense ratio, the timing of the market around the years you start pulling money out. This is the structural reality that even well-designed calculators smooth over because they model average returns rather than sequences. Sequence risk specifically affects people who are withdrawing money from their portfolio. When you sell investments during a downturn to cover living expenses, those shares are gone forever and can't participate in any recovery. This is completely different from the market risk you faced while accumulating. During the accumulation phase, a 20% drop is a buying opportunity. During the distribution phase, a 20% drop forces you to sell at the worst possible moment to fund your monthly expenses. The 5 years before and after your retirement date are the highest risk window for sequence returns damage. And this is also why $750,000 demands a different positioning than the aggressive posture that built it. The supertanker is moving at full speed. You do not want to hit a storm with no ballast. The fix is simple but psychologically uncomfortable for people who know that cash is a bad investment. Hold 1 to 2 years of actual living expenses in cash or very short-term instruments. Not because it earns anything meaningful, but because that cushion means you never have to sell equities during a crash to pay your electric bill. It transforms you from a forced seller into a patient one. A client who panics and shifts to cash after a 40% decline has done more damage than the sequence of returns itself. The buffer prevents that panic trade from ever becoming necessary. It's the most boring, highest return move available at this net worth level, and it costs you almost nothing in long-term compounding. And here is the detail that makes the supertanker metaphor click in a new way. A speedboat captain reacts instantly to a wave. A supertanker captain plans the route weeks in advance, because at that scale, reaction comes too late and at too high a cost. The cash buffer is not a reaction strategy, it is preparation. The automated investing is preparation. The fee audit is preparation. None of this feels exciting in the moment. Every single dollar of it pays in decades. And every single time I explain sequence of returns risk to someone hearing it for the first time, they nod carefully, say, "That makes complete sense," and then immediately go check their portfolio on their phone. Which is the financial equivalent of understanding that looking directly at the sun damages your eyes and then staring at the sun. Before we get to the 3 practical takeaways, here is the angle that quietly separates wealthy people from people who simply have a high account balance. And it's the one that gets skipped most consistently. Before we get there though, there is one more structural lever hiding inside the location of your money. Not how it's invested, but where it lives. That at $750 is worth thousands of dollars a year in completely avoidable taxes. At $750,000, your money likely lives in a traditional 401k, a Roth IRA, a taxable brokerage account, and possibly a money market. Here is what almost everyone gets wrong. A dollar in each of those accounts is not worth the same dollar. A Roth dollar is worth more than a traditional 401k dollar because it's already been taxed. Every future dollar of growth in the Roth is yours to keep. The 401k dollar will be taxed as ordinary income when you pull it potentially at your highest marginal rate. The strategy built around this is called asset location, and it requires no new investments, no market timing, and no advisor fee to implement. Put your fastest growing assets, aggressive index funds, small cap equities inside the Roth. Those gains compound tax-free forever. Keep your bonds, your REITs, your dividend-heavy funds in the tax-deferred accounts where the bite is smaller because the growth is slower. Vanguard research found that tax loss harvesting alpha, the additional annual after-tax return achieved through systematic harvesting, can range between 0.47% 1.27% annually. On $750,000, 1% is $7,500 per year, every year, with zero additional market risk, with no change whatsoever in your actual investment positions. Tax loss harvesting involves selling securities at a loss to offset gains in other investments or income if capital losses exceed capital gains. You can reduce taxable income by up to $3,000 for the year. When the market dips, you sell a losing fund. Immediately buy a similar but not identical one and bank the loss as a real deduction. You maintain virtually identical market exposure while turning a paper loss into a real tax benefit. Then there's the piece that requires the least financial sophistication and is most consistently ignored: lawsuit protection. At $750,000, you have a target on your assets in a way you did not at $50,000. A car accident where you are found at fault. A contractor injured on your property. A personal injury judgment that exceeds the liability limits on your homeowner's or auto policy. Any of these can directly pursue your accumulated wealth. An estimated 1 in 5 people with considerable wealth do not have umbrella coverage. That is a staggering gap for a product that costs roughly $300 to $400 per year for $1 million of additional liability protection. Umbrella insurance is surprisingly affordable, especially considering the extensive coverage it provides, typically between $300 and $600 annually for $1 million of coverage. Most people insure a $35,000 car with comprehensive coverage. They leave a $750,000 net worth exposed to a single lawsuit. That is a speedboat mentality applied to supertanker stakes. The wealthy build moats around the money they already have, a basic will. Updated beneficiary designations on every account check right now for ex-partners, deceased relatives, or blank fields on accounts you opened a decade ago. An umbrella policy. These 3 things cost under $500 in one afternoon. They protect assets that required years of discipline to accumulate. There's a comedic version of this, and then there's the real version. The comedic version is that people will spend 2 weeks researching which index fund has the lowest expense ratio and 0 minutes filing the paperwork that protects the entire portfolio from disappearing in a lawsuit. The real version is that this is the exact pattern that plays out. Because the expense ratio research feels like investing, the paperwork feels like admin, and the brain has been trained since childhood to treat admin as optional. Here is where the final escalation lands. The 3 most expensive decisions at $750 are all invisible in the moment. The fee you're paying but not seeing as an actual dollar amount, the lifestyle upgrade that feels proportional and earned, the legal exposure that has never been a problem until it suddenly is. None of them trigger an alarm. None of them feel urgent when everything is running smoothly. They are all the category of thing you say, I'll get to that eventually, about, until eventually shows up at the worst possible moment. Let me show you this in one concrete scenario. Marcus is 49 years old. He hit $750,000 in early 2025. Smart guy, disciplined, saver. Made all 3 mistakes with elegant efficiency. Upgraded his apartment the same month. His number crossed the line because he'd been telling himself for 3 years that he deserved it. And $750 felt like permission. He's now paying an advisor 1.2% annually, $9,000 per year, for a portfolio that over the past 3 years has returned almost identically to a basic total market index fund after fees are factored in. He has no umbrella policy, a will drafted in 2014 with an ex-girlfriend listed as a beneficiary, and a cash buffer of exactly 0. In a flat market, Marcus looks fine from the outside. In a bad sequence over the first 2 years of retirement, Marcus has built a beautiful supertanker with no ballast and a slow leak below the waterline. The money is real, the risk is equally real, and none of it feels urgent yet. The version of Marcus who spends one Saturday auditing his fees, automating his investments, filing the paperwork, and adding the umbrella policy doesn't look any different on the surface. But in 10 years, his supertanker is still moving. The other one is listing. Let's put this in numbers. Jordan is 52 years old. Net worth exactly $750,000. $400,000 in a 401k, $150,000 in a Roth IRA, $200,000 in a taxable brokerage. Jordan earns $94,000 a year and saves $12,000 annually. Scenario A, Jordan changes nothing. Keeps paying a 1.2% advisory fee. Lets spending creep up by $1,500 a month over the next 3 years. As income rises, no umbrella policy, no updated will. At 7% growth with fee drag, the portfolio lands around $1.3 million at age 62. Jordan retires, pulls $50,000 a year, hits a 30% crash in year 2 of retirement with zero cash buffer, forced to sell equities at the bottom to fund withdrawals. Those shares never recover. Portfolio exhausted around age 81. Scenario B, Jordan spends one Saturday, consolidates accounts, moves to low-cost index funds, drops total annual fees from 1.2% to under 0.1%. Freezes lifestyle. That $1,500 per month stays invested, adding $18,000 a year in compounding capital instead of lifestyle overhead. Builds a 24-month cash buffer. Files for umbrella insurance at roughly $380 per year. Updates the will and beneficiary designations in a single afternoon. At age 62, portfolio lands closer to $1.9 million. Same $50,000 annual withdrawal. During the crash in year 2, Jordan doesn't sell a single equity share. The cash buffer absorbs 2 full years of living expenses while the market recovers. Portfolio projects to last well past 95. Same income, same starting number, same market conditions. One Saturday's worth of decisions separates those two outcomes by over $600,000 and 15 years of portfolio longevity. That gap is not the market's fault. That gap is a handful of specific choices made or not made in the months after hitting $750,000 for the first time. Let's bring this back to the opening. $750,000. It feels like a finish line. It isn't. It is the most dangerous moment of your financial life precisely because it feels safe. You've done the hard work. The discipline is behind you. The brain registers that as arrival. But the number is now large enough that it can lose more in a week than your paycheck can replace. According to Federal Reserve data, net worth peaks for most households in their mid to late 60s and then begins to decline as savings are drawn down. The people who preserve and grow it past that point aren't doing anything glamorous. They're reading statements, they're filing paperwork, they're not reacting to headlines. They're letting compounding do its job while staying out of the way. Here are the 3 specific moves to make the moment you cross this line. Not generic advice specific to this number and this moment. First, the fee audit. Pull every account you own. Look at the expense ratios, the advisory fees, the platform costs. Write the total in actual dollars per year, not percentage, dollars. If that number exceeds $3,000 annually, you have work to do. Move toward low-cost index funds with expense ratios under 0.1%. If you genuinely want comprehensive financial planning that includes tax strategy and estate coordination, a fee-only fiduciary advisor charging a transparent, flat annual fee is worth the investment. But you must know exactly what you pay and exactly what you receive in return. The fee paid in ignorance is always the most expensive one. Second, automate the decision that removes your emotions from the transaction. Set your monthly investment contributions to fire automatically on payday before you see the money, before you can feel the temptation of the extra cushion in your checking account. Pick a specific dollar amount. Remove the brokerage app from your phone's home screen. Add friction to every impulsive trade. Make the default action inaction. At $750,000, the investor who checks less frequently and reacts less reliably almost always outperforms the one who is engaged and attentive. The supertanker was already pointed in the right direction. Stop adjusting the wheel. Third, the defensive paperwork completed in a single afternoon. Update beneficiary designations on every account you hold. Look specifically for ex-partners, deceased relatives, or blank fields on accounts opened years ago. Get a basic will if you don't have one. Add a durable power of attorney. Then call your insurer and add a $1 million umbrella policy for roughly $300 to $400 per year. This is proportionally the cheapest financial protection available at your net worth level. One lawsuit without it and a decade of discipline can disappear in a courtroom settlement. The great inversion of wealth is this. In the early years, action builds it. In the later years, restraint protects it. Nobody warns you about the transition. Nobody tells you that the hustle, the side projects, the aggressive reinvestment, all the habits that worked from 0 to 750 are now the habits most likely to talk you out of it. The discipline at this level is a different kind. It's the discipline of doing almost nothing on purpose, of not reacting, of not upgrading, of not chasing the next compelling opportunity, of sitting still at the helm of a supertanker that is already pointed in the right direction and trusting the engine you built to carry you there. Charlie Munger said the first $100,000 is the hardest part to accumulate. He was right. But $750,000 will unmake itself far more quietly than it took to build. And the people who protect it aren't doing anything impressive on the outside. They're boring. They're patient. They're looking at their accounts once a month at most and then closing the app. Lazy investing built more fortune than crypto memes. The number you protect will always outlast the number you chase.